Yeah. So we are finding the intrinsic value. As you know, you find the intrinsic value. This is nothing but the expected value of a stock based upon your own estimation based upon your own estimation. The estimation is very clear that you expect when you want to do an investment, you expect some dividends in the future, and you expect some returns. So when you discount the expected dividends with the expected returns, you can expect the like stock value in the future. That means the intrinsic value. Okay. So we have already done the calculation of intrinsic value, but here we are using another model to find out the intrinsic value of stock when some additional data would be given to you, like the dividends what we are going to earn, we are going to reinvest, it seems, and it is going to grow by some percentage. So the growth rate would be given to you. When such kind of question comes whereby they give you growth rate and ask you to find out the intrinsic value of a stock, okay, so you will use this formula for the calculation. So the data would be that dividends what you are getting, okay, in the future is growing at some fixed rate. When will it grow at fixed rate? If you reinvest it, correct? So investors don't keep the money idle. They really want to reinvest what they get. That is what the investors mindset is. So when the in general what I'm saying, okay, so like when the dividend is expected to grow in the future, the dividend growth model. So this model is called dividend growth model. This is also one of the models to find out the intrinsic value of a stock. So an adaptation of the zero growth model. So previously we had zero growth model. Now we have dividend growth model. And this is also helpful to value the stock. Okay. So the formula is next annual dividend. So they would give you D naught, the current dividend. And to find out the next annual dividend, which is going to be D1. So D1 is equal to D naught into 1 plus G, 1 plus growth rate. Okay. So you get the next dividend by investors required rate of return, that is what is the cost of capital minus the annual future growth rate of the dividend. So why are you subtracting this annual future growth rate of the dividend? In the numerator you are adding the growth rate, that means you are multiplying the D naught with G. So you show that your dividends are growing. Okay. So now what you're doing is, if in denominator you are discounting this, see, please understand, if in denominator your cost of capital is some percentage, and if you are discounting the future dividends, okay, with a higher cost of capital, then what it would show that the dividends aren't growing. That means this growth effect would not be captured. Understood? For example, so you got a dividend of $10 and it is growing at the rate of 2%, and the cost of cap hello and the cost of capital is, let's say, like 12%, like 14%. So what I'm doing is 0.14 minus 0.02. I'm doing this. Why I'm removing this from the denominator, from the cost of capital? Because in the numerator already I'm just adding up that growth rate. If when I get the dividend, I discount it with a higher discount rate, so this growth what I'm getting, okay, would be eliminated. It would be of no use for me to do that in the numerator, to just add the growth rate in the numerator. So I want to show the dividend growth effect, since I want to show the dividend growth effect, and I add that dividend growth rate in the numerator to really show that growth effect, if I again discount with a higher cost of capital without removing this growth rate, what am I doing is, I'm not, it is nothing but I added in the numerator and I'm removing from the denominator. I'm adding in the numerator and I'm removing it from the denominator. That means I'm discounting what I added. So what will I do is I will remove how much I added in the numerator, then I'll get a proper rate, that is 0.12, and that would be the rate with which I will be discounting my dividends to get my stock value. Okay. If I discount with 12%, I'm discounting with a 2% lesser rate than the expected rate what I have. If I'm discounting with 14%, I'm discounting with a 2% higher rate, and that is really removing the effect of growth rate in the numerator. Okay, so hopefully I think you understood what I'm trying to say. See, it is not only the sake of doing a question by remembering the formula. If you know things technically and if you know conceptually in examination, when they ask you theory questions, you will be in a position to answer. Okay, so I want you to do this question right now. Please do this. I'm waiting. So I have already told you dividend into 1 plus growth rate. That growth rate is given to you in the question, divided by the cost of capital, or like required rate of return minus the growth rate. Okay, please do this. Finish. If you finish it, I'll move.
Yes, sir. Done.
Doing okay.
Done. Sir, what is the textbook page number for
Sorry,
the textbook page number?
I'm not sorry.
No, the material reference page number is what, sir?
Okay, page number 159.
Okay, sir. Thank you, sir.
Yes, 159. Okay, let's go to the next concept. Like expected return. The next one they're asking is expect. So expected return for each stock is a function of actual market price. So what you're doing is, it's very simple. Dividend by stock price will give you the return. Okay. So here the intrinsic value of a stock. So they're asking you the intrinsic value of a stock based upon dividend. This. So what is that they're asking? Stock A has a beta of 0.5, and according to CAPM, the required rate of return is 2.25%. So beta is given, CAPM required rate of return is given, intrinsic value of the stock based on dividend of 1.98 is been given. So now, however, stock A's actual market price is 49.50, but why? Stock is expected return based on its market price of this, and its expected annual dividend 1.98 is 4%. How you got this? Very simple. You took the dividend and you took the stock price. So dividend by stock price would give you expected return. Just have a look through this question. We'll move forward. See, the only difference what you see in the data is the intrinsic value of the stock. What you calculated was $88. This was the intrinsic value of the stock. Okay, on based upon this dividend. But the actual market price is 49.50. Okay, so stock is expected return based on market price they have calculated. That's it. Now we'll move forward. Okay, you can have a look through. I'll move forward. Okay. So can you do this question? So stock C's beta is given according to CAPM. The required rate of return is given. Intrinsic value of the stock is C based on expected dividend next year of this and expected growth rate of this has been calculated. Okay. However, stock C's actual market price is this. So they're asking you to find. So this was the model whereby you found out the expected return based on the market price. The dividends are given, how much dividend you are going to receive, and the actual market price is also given. The same question we are going to do like here. The similar kind of concept is applied, but we have growth rate. So when you have growth rate, you have to add the growth rate here. So the formula goes in this way: dividend by stock price, that is the stock price is the actual market price, plus the growth rate. Okay, just do this question, we'll move forward. Okay, now so as we have already discussed the CAPM equation, just a second. Now you can do one thing. Can you do this question, CAPM question? Then I'll explain you the graph. Okay, come on, just read this. Do this question, CAPM question. I'm waiting, come fast. And you should explain me what is happening in this, okay? The basic thing what is happening here, I'll ask you. Just do this. So the thing what you will be seeing here is when you like increase, when the beta increases, the risk increases, and the risk increases, the returns also increase. So here it is 3.3% with 0.8 beta. Here the beta is 1.3 and the return is 5.05. Okay. So why this is happening? Because of the higher risk, the investors want to be compensated with higher returns. They would be satisfied, okay, with that. So this is what we discussed. The same thing you can see here, and so what is the risk premium here? What is the difference between the difference between this and this is nothing but the risk. The difference between the market return, the this is RFR, and the market return is premium. Premium multiplied with beta becomes risk premium. Okay, because the risk factor comes into picture. So that's what they have explained. You can go through this. Okay, let's discuss about this graph, what they're saying. See, this is a security market line. Security market line shows you what the risk and return combination. For a risk of 0.5, that is when the beta is 0.5, the return should be somewhere here. It should be, in actuality, it should be. That is what the CAPM equation is all about. CAPM equation, when you take CAPM equation into consideration, it's a linear equation. So what is the what kind of linear equation it is? It is like y is equal to a plus bx. So I'll write here required rate of return. So required return is equal to risk-free rate, which is constant, that is a, plus b, slope, which is beta, into x. X is nothing but the dependent variable. Okay. So this is the independent variable. This is the dependent variable y. The required rate of return is the dependent variable, which is dependent on the risk what you take. Okay. So this is the independent variable. Okay. So if you increase the risk, the returns would increase. Okay. So that is what it is. So with this particular systematic risk, we have this returns. For 1.5, we have this returns. Okay. That is what the CAPM tells. So that should be the required return. If suppose, now please listen very properly, for this risk, if you get this returns, so the stock is underpriced. For this risk, if you get this returns, the stock is overpriced. But why? Can anyone tell me? So what they have given in the statement is C. Stock has a beta of 0.5, and according to CAPM, the investors required rate of return should be 2.25. As you can see here, they did not write here, but like 2.25 is about 2. The intrinsic value of the stock based on its dividend of 1.98 and its investors required rate of return has been calculated as 88. Okay. So like what they're saying is the intrinsic value they have calculated based upon what the dividend what they have and the required rate of return, that is 88. You can do this, you can calculate this and tell me. So you'll get 88. Okay. So they have calculated, it seems they have calculated, what they have calculated is with the given risk what we have here, the return should be 2.25, and with this particular return and the dividend what we are expecting, this one, the stock value should be 88. Okay. However, just a second. Yeah, so what you are seeing here is for a given risk of 0.5, okay, this is the only risk, the systematic risk. The return should be 2.25. And with this return what we have and the dividends what we have, we can find out the stock value. So for this combination, the actual stock value should be $88. But now see, the things would change. Now what would happen? However, since stock is actual market price is 49.50, see, this is the intrinsic value 88, but actual market value would be different, correct? That is decided by the market participants. Stock is expected return is 4%. Okay, so again, now what was your required rate of return? See, required rate of return is calculated with CAPM equation. Okay, that means this shows that what should be your required rate of return, that is your estimation now. But you know, things would be different in the market in actuality. So in actuality, the market price is 49.50 and is expected return is 4%. Okay, because is stock is expected return is higher than investors required rate of return. For the security, A is underpriced. So what happens? The required rate of return is 2.25%. Correct? So you come to the concept of bond price. Company is giving you 2.25, and in market the rates what we are saying is 4%. Let's say, see, you come to that concept of bond price. Company, so required rate of return is 2.25, that is the required one. Suppose the company is giving you 2.25 and in the market the return is 4%. So your stock will be overpriced or underpriced? Please tell me. I'm asking you, company is paying 2.25% to the investors, and similar kind of bonds in the market are giving 4%. So if you want to sell your security, will it be overpriced or underpriced? You will be selling at higher value or lower value? Hello?
Lower value, sir.
Lower value, understood fact. Why? Because in market the securities are
Market
offering
return
more and
4.
your company is
Yes.
giving less. Since your company is giving less, your company's stocks demand would be less. It will be sold at a lesser price, and vice versa. If your company is, if the required rate of return is 2.5%, so I'll write a note here: required rate of return less than expected return. Stock is underpriced. Why underpriced? Because company is giving this, you can assume in that way, and in the market the things are at 4%. So definitely your stock, if you want to sell, will go at lesser price. If the required rate of return is 2.25%, in the market the rate is 1%. Market, in the market people are getting 1%. In the market people are getting 1% returns. So your stock will be overpriced. Why? Because people will be ready to pay a higher price to buy your stock. So here vice versa thing comes into picture. So what happened here? When required rate of return is more than expected return, the stock is overpriced. You don't make this as your mantra, but you should know the concept behind this. Okay, so see here, when the required rate of return is less than the expected return, the stock is underpriced. When the required rate of return, which is this, is higher than the expected return, the stock is overpriced. Okay, please go through this concept. If you have any doubts, you can raise it right now and I'll move forward there. Okay, let's move forward. So let's say the impact of changing market conditions on the security market line. Just a second.
Sir, you're on mute, sir.
Oh, sorry. I understood. So the heading was impact of changing market conditions on SML. So market conditions would change. I'll explain you how. So this is the risk-free rate which is constant. Okay, it won't change. And with the increasing risk, the returns also increase. But you assume that the risk-free rate has now increased. That means if I change the risk-free rate, yes, governments what they do, the benchmark rate they sometimes increase or decrease based upon what kind of requirement they have. Okay, the interest to control the inflation, the governments may also increase interest rates. There are various factors. That's a part of monetary policy. Suppose there is a lot of inflation, so in during those times, government would encourage people to invest more or deposit more in the financial system. Why? Because they don't want more and more money to be spent on some goods which are of which which are not that worthy. That means unnecessarily the prices are high for them. They are not the ones which are to be sold at higher prices. But because of inflation and unnecessary demand or less supply of various factors, the prices are have gone up, and people are spending more, and they are and the finance and they are withdrawing more from the financial system, that is banks and other sources. With this, what happens, the economy becomes unstable. So to stabilize the economy, they increase the interest rates, so they increase the benchmark rate. So for example, if they increase the benchmark rate from some 0.5 to 1.50, so what happens, there is a shift in SML. So the SML now would start from here. That's a very easy understood thing. And then here, okay, that's it. And then what happens, your expected returns, that means your required rate of return would also increase. Okay, why? Because with 0.05% as your base, the returns were some XYZ percent. Now with 1.5%, it will be higher than this XYZ. Now one more thing, now the risk aversion. See, I have already explained you in my first class about the types of investors or kinds of investors. There are some people who don't want to take a higher risk. They want to take less risk, but they expect more returns. Those are called risk averse investors. Those are the ones, if I tell you the combination is in this way, for 0.5 beta, the return should be 2%. But the risk averse guys would say, for 0.5 beta, I should get 3%. That means the risk should be less and the return should be high. They would be looking for those kind of options. So when you have that kind of scenario, so when you make the graph for 0.5, if you put 2, for 0.5 you have to put 3. So your graph would be here for risk averse investors rather than here in normal scenarios. So you see the risk averse investors graph is more steeper. That means that is more like, it's not somewhat flatter, it's more steeper. Okay, because for the given risk they want more returns, so the graph would be more steeper. Okay, that's all. Please do these questions of reading. These are very simple ones, so you can do this question also. I don't think this is a complicated one, easy one. And then last comes the concept of portfolio theory. And this will be the end of the chapter. We can start new chapter from the next session. See, portfolio theory is nothing but don't put all your eggs in one basket. I always say if you put all your 1 dozen eggs in one basket, and if it like by mistake if you drop it, or someone has like pushed you, or like by mistake you got pushed by someone, maybe or someone hit your hand or something when you were carrying this. So what happens? All would get damaged. So instead of that, if you take 6x in one basket, and one basket you take 6x, you make a, I can say, portfolio of X. For example, that's nothing but like you are like taking two different baskets, and if one falls, you have this. Okay. So in the same way, we say that you don't invest in one company. If like if you want to see, I cannot say that for specific investors, the goals and aims are different. They have a different kind of requirement and a different kind of expectation. Some say that why don't you put your money in stocks? They would rise. There would be a surge in the prices. Like the rise would be on a higher side. But some say I don't want to take risk. I want to put in mutual funds. I want a balanced return. I'm not the one who's looking for very high returns because I don't want to take that risk. Okay. So they prefer pure portfolio. Mutual funds are the best example of portfolio. So what kind of portfolio an investor should make? Investor should make a balanced portfolio with a combination of risk-free or less risky and some risky stocks or investments. Okay, so you should have a combination of risk-free asset, less risky. So I can say 70% you focus on this, 30% you focus on this. That means 30% you have a proportion of these stocks also in your portfolio. So what would the benefit you get is if these gives you return, it's a jackpot. Okay, but if this doesn't give even this particular returns, what you get, you can absorb the losses of this in this. Okay, so that is the benefit of a combination, a portfolio with a combination of risky and less risky and risk-free assets. And the risk is only systematic. I already told you that is the only risk which you have, the market risk. Okay, so if you have invested in some ABC company, and what happens is there is a risk, I understand, because if this company doesn't perform well due to any reason, there's an unsystematic risk which is associated with this company. How? Unsystematic risk is a risk which is internal to a company. Maybe there can be there may be a fraud which can, there may be someone who has done a fraudulent act in this company, because of which the company has gone into losses, because of which the investors are going to suffer. So that is with the downfall of this company, the entire market won't crash. But if so here what you can do is you can eliminate, I can say you can minimize this unsystematic risk by diversification without spending any money for this. That means either you can take the help of a portfolio manager, you pay some fees to him, or else you yourself can diversify. You yourself can make a portfolio. When it comes to systematic risk, it is already, you have already diversified your investment. So now there's no chance for you to further diversify. So that this is the only risk which we have. That means if there's a market crash, every stock, every company has to suffer. That means that the market crash can happen when there's a COVID, the pandemic comes into picture, the war comes in, there's a war happening between two nations. So the markets usually crash, and that time every stock would underperform. Okay, and that is the only risk what an investor has. That further cannot be reduced by diversification, because you already have a diversified portfolio. And these are the lower risk securities, these are the higher risk securities, these are the medium ones. So you can have a combination. These are government bonds, least risky, because never US has never defaulted on their bonds, on the government bonds. Higher ones are common stock or convertible preferred stock. Everyone knows it. And these are the bonds which are less risky ones. So you can make a combination of any of this. Coefficient of correlation are in portfolio theory. So coefficient of correlation tells you the strength of the relationship between a portfolio. For example, if I make a portfolio of Infosys, I have a 2-stock portfolio. That is Infosys and TCS. I am only interested in software company stocks because I think like the pandemic and these kind of scenarios, stressful scenarios won't have an impact on these kind of companies because they can work online. Okay, you have seen many of the people are working online, your relatives or maybe your parents or who are like working in software. You have seen that they have worked like consistently and constantly. They've been working during the pandemic days. Even nothing has interrupted their job. So seeing all this, I have taken these two stocks in my portfolio. Now the thing is, like I need to like there is a word called covariance. This is a statistical concept. The formula is x minus x bar into y minus y bar, the summation of the product of this, summation of product of this divided by n. It would be differing if you go to Google search. Again, if you go and Google out, you'll be seeing n minus 1 and n. In the denominator, you'll be seeing n minus 1 and n. So don't get confused. One is for the population, one is for the sample. So don't go into that mechanics. It is not there in your syllabus also, but I'm trying to explain you the things here. This is covariance. Suppose I got a covariance. I have found out the covariance of these two stocks. If you want to get further details on this covariance, I can share my video of portfolio management with you. You can go through that video and you can check that how I have explained the covariance and correlation concept, okay, technically. So if you are curious about that, I'll send you. It's a good topic. Of course, you should know. So you can go through that. That I have given classes for the CFA students because that is they have that in details, you don't have. So I am not going into this. So covariance I found out, and the covariance between Infosys and TCS is, let's say, 200 is the number I got. This is the number. What does this 200 tell? This tells that there is a positive relationship between Infosys and TCS. That means if Infosys stocks would go up, the TCS stocks would also go up. So this shows the direction. And when I say about positive relationship, if Infosys stocks would go down, the TCS stocks would also go down. That is what is the positive relationship all about. But that means if there is any impact on this, the impact is also seen in this, because those are very closely related ones. That means those are similar kind of businesses in similar industry and almost all the same kind of business they perform. Okay, so that is what covariance tells. But if I get a number of minus 200, that means it tells if Infosys goes up, TCS will go down. So there's a negative, they are in negative directions. They are not going in same direction. They are going in opposite direction. There's a negative relationship. But the only point what we are concerned here is with, fine, if this goes up, this goes up, this goes up, this goes down, this goes down. If this goes up, this can go down. These are the three scenarios. But I want to know if there is an impact on Infosys, what kind of impact it has on TCS also. That means if Infosys stocks are going up by 20%, TCS stocks are going up by how much percent? More than 20% or less than 20%? That is what I want to know. That covariance cannot tell me. Covariance can only show me the direction. This 200 can be 2 lakh also. Then the covariance can take any number. But that doesn't tell you the strength of the relationship between these two stocks. What I'm saying, strength of the relationship. I only know the relationship here. The relationship is positive or negative, but I don't know how strong they are related. Okay, the relationship between a mother and a son is very strong. A daughter and father, or daughter and mother, or daughter and son and father is very strong. We are very much we are very much associated with our parents. If something happens to us, they definitely get hurt. Okay, so there the strength of the relationship can be seen. So that's what I mean to say. If this is going up, this is going up, fine. This is going down, this is going down, fine. This is going up, this is going down, fine. But if this is going up, how much this is going up? Or if this is going up by 10%, is it going up by 10%? The stocks are increasing by 10%. That is what we want to know, and that we can know with the help of correlation. So Correlation is nothing but it is a correction to covariance. Okay, with covariance people were not getting the answers, so the correlation was brought into picture. So I will not go into derivation of correlation, okay, but I will explain you what this is. So correlation can be put into a scale of -1, +1 and 0. Okay, so what does it mean? Plus one means positive, that is perfect positive correlation. -1 means perfect negative correlation. 0 means no correlation. Okay, so let's say that I have found out the correlation between Infosys and TCS stocks, and I got the correlation as 0.70. What does it mean? It means the strength of the relationship between TCS and Infosys is in this way. So what we would interpret with this 0.70, this is positive, is if Infosys stocks are increasing by suppose say 10%. Okay, if the Infosys stocks are increasing by 10%, there is 70% chance that TCS stocks would also increase by 10%. So what is the strength of the relationship here? The strength of the relationship is only 70% chances, not 100%. So they are related. So how are they correlated? They are correlated by 70%. That means the strength is such that if this goes up, 70% chances that this would also go up. Okay. So if Infosys goes up, let's not write the percentages here. Let's say some X%. Let's say some X% to make it more clear. If Infosys stock increases by some X%, there is 70% chance that in TCS stocks would also increase. I'm not saying by what percent, but it would increase. Now, if the correlation is -0.70, that means if Infosys stock goes up by some percent, some X%, TCS stock would, there is a 70% chance that TCS stock would fall by some A%, let's say. Okay, because I don't have a data here, so I cannot calculate and tell you the things. I have done all this in my video. I'll share the video whereby I have taken the data and I've done the calculation. So now again I'll come into picture. So 0.70, when Infosys goes up, 70% chances that TCS would go up. Minus 0.70, when Infosys goes up, 70% chances that TCS would go down. 1, if Infosys goes up, 100% chance that TCS would also go up. -1, if Infosys go down, TCS would also go down. That is 100% expected. Okay, that is the strength of the relationship, what correlation tells us. With this we end the chapter. Okay, so now we are done with this chapter called risk and return. Tomorrow we will start the cost of capital. So I will finish this in one session, almost all. One session is like enough for that. Then we'll go for CVP analysis. Okay, so thank you, have a good day.
Thank you, sir.
Thank you. Yeah, can you cancel the call? Why? Because I did not make the call. Zarina has made the call.
Yes, sir. Very much.
Yes, I'm doing it.
Yeah. Okay. Yeah. Thank you.